Hi, in this video I'm going to look at a question that was asked recently about when do you actually give up on a strategy? When is it that you think, well, that doesn't work? Well, it's a really important question, and it's one that a lot of people don't give a great consideration to. In fact, they don't even think about it, particularly when they're starting off. Now, the most important aspect for a lot of traders is just finding strategies, really good strategies. That's all they want to know. And when I say really good, they don't even ask whether they're really good. They're told they're great. This is the best strategy ever. You've heard it. It's out there everywhere, and a lot of this research is done from the web. It's an absolutely fantastic resource. You can find some brilliant strategies out there free of charge. You can find different trading ideas, knowledge. There's a wealth of it. It's putting it together which is the most technical aspect, and understanding what you're looking at. So this is one video that might just sort of give you, if you've got a strategy you're using, it might give you a bit more idea what to look for. And at the end of it, I'm going to tell you about a webinar I'm doing in a couple of weeks' time. Of course, other people are drawn in by the courses where people with showing you their wealth. It sort of draws you into thinking, I can do that. So it works on the greed factor, and you'll follow anything for greed. If it allegedly works for them, it will work for you. So, and you'll be wealthy. So there's the other people out there which are trying to draw you in on often false pretenses. 72% of FX traders have never traded anything else, so there's a lot of people that are pretty green in terms of trading, and it's important that you do understand something more than you're often taught, and you'll find in bits and pieces around the web. Just finding strategies will never teach you about the psychology of trading or anything else. Well, it will. You'll either give up, or you'll start doing something and then you get drawn in. Then you go and look for the psychology aspect. Why can't I do this? Of course, a lot of people will try out strategies but then discount them very quickly. So these are the sort of things we're finding. The question was really about, should I get rid of this, not trade this strategy? It doesn't seem to be working. What do you think? And well, they really need to ask more than it doesn't work. What do I think? They need to test it, or at least look at it. One of the questions often, if you're looking at some of these strategies on the internet, you should be asking or looking for is, does it still actually work? Some strategies that worked 10 years ago, 2 years ago, 6 months ago might not work in the current conditions. The markets change. We get more into larger, choppier zones. Sometimes we get into big trending zones. Something that's designed for trending might not work in chop, and vice versa. What a lot of people do ask, I say a lot, not all do, some just follow blindly the guru talking about his strategy. However, they don't really ask about the win rate or the stats around the back of the trading. Stats are so important for the psychology of your trading. You'll have a lot more belief if you can know what the numbers are. However, a lot of people don't ask that at the beginning because they don't understand. What's the risk reward? What's the average risk reward of your trades on the strategy? Again, never really asked. It's one of the most important numbers to look at, because then you can, once you've got the win rate and the risk reward, you can look at the expectancy and see whether that strategy is indeed a one as a keeper. If it has a negative expectancy, obviously it either needs tweaking, or that's the time that you bid it. But you'll only know that by testing it. Other questions may be, what is the drawdown? Very important question, particularly what I'm looking at here. When to discard a strategy, look at the drawdown. But of course, there is an important point to that, which I'll come on to in a moment. Now, there's loads of other questions you can look at. There are things like the Monte Carlo numbers, etc., which is the way things are calculated out. There's loads and loads of different things that you should be looking at when you're looking at a strategy, just to give you an idea of the whether you'll go bust with a strategy, or what's the probability of it going bust for you. So all these numbers, unless you look at them, how can you trade confidently with the strategies? Now, some of the results, when you're looking at results, let's just take this this series of results here. This is of a strategy. I won't tell you the win rate at the moment, but what I'd ask you is, would you dump it? This is the last 8 results of a period, or the 8 results that came out in line, I should say. Would you actually want to continue trading that after those 8 results? Think of it to yourself. Probably not. Some will say, well, if it's gone through like that, surely it's going to have some winners. So they might have that great expectations, different expectancy theory there. But you won't know by looking at 8 results, is that basically the answer here. The question is, when do you stop? It's when you've seen enough results. The most important factor is the size of the sample that you're taking. 8 results over a year, or 10 years, 5 years, it's nothing. If it's just too small. If it's a big number, if you're sort of working in, you can see that over a rolling period, this strategy is not working. It's having far too many losses. Then you might be taking stock of things and saying, okay, now I can decide on not trading it and just monitoring it for a while. Of course, you've got to be careful, because some strategies, they start off really well, they have their markets change, the dynamics change, and then they come good later. So again, it's all about drawdown in terms of your money. What you don't want to be doing is seeing a consistent drawdown from a strategy. It has to have those at least some peaks in amongst there to restoke the money you might have lost on the drawdown periods. So size, most important factor. Let's just look at those results. Came from a spreadsheet I kept. Now these were live trades that were taken last year on a strategy, and the period I picked out was just here. So it started off the year 3 decent results. Now this is a fixed exit target of 1.3%. That's the target. The risk is 1%, so it's got 1.3 to 1 risk reward that's set on there. Now it doesn't sound very much often, but it's then with the probability and everything else, it gives a good expectancy. So based on results, of course. So over the year here, you had that roll of losses, and there were still pockets of drawdown amongst everything here. But it picked up, and over the year you can see it had some decent runs of winners together, a bit of a mixed bag. But the important thing at the end of the day, was it profitable? Yes, it did, just shy of 27%. If you missed some of those trades, let's say you made 20%, 18%, one trade, one strategy, one currency pair, that's it. So the important thing is, for those people that would have scrapped it on those 8 results, would you have traded it now you know what happened? Well, the question probably is, yeah, I quite like that now. So it's all about size of your sample. Trading and testing too little on the way backwards doesn't pay off in the way forwards, because you don't know what to expect. It's that great expectations, I guess, at the first place, without having a decent rollback. Now strategies come in and out. Now what I'm doing, I've been working with a piece of software that is out there in the market now, and I'm going to show this on a free webinar I'm doing on Saturday 13th of May, 10 a.m. even. There'll be no fit state at 10 p.m. At 10 a.m. in the morning, it will be for about an hour. Now what I'll do is I'll look at a bit of software that you can use and pop your strategies in and just see for yourself, and you can run over them in a semi-automatic. So if you're a bit of a discretionary trader, you may have a setup you like, so it will stop every time a strategy comes along, your setup, and then you can decide on how you would normally trade it, and you can put your rules in when that setup comes, and you can do it that way. You can do it fully automatic. It's got the opportunity, the best of both worlds. I like the semi-automatic, where it just finds the signals first, because it allows me to look at what it's like at that time of trading, and then you can build this up. You can look over things a lot easier, a lot quicker, and it's got a lot of advantages to it. But you can build up that mass. The most important thing, as I said, is the sample size. You can build up your sample size not over just a few weeks, months, but years, and it doesn't take a great deal of time to set it all up. So there you go. Question: when should you give up on something? When the expectancy drops below 1 overall over a period with a big enough sample size. Big enough sample size, what is it? I would suggest you're looking at something generally over a year. You've got to be it can be a rolling year, so you can roll your results over different periods and set the periods and look at how it's doing, and just keep if it's slowly, gradually working into that point where it's no longer profitable and it's starting to go loss after loss, the expectancy theory based on your current win rate is below 1, then that's the time to say, well, actually this strategy is not working. There we go. Hope you find this useful. I'll see you, or speak to you. I won't see you, but I'll speak to you on Saturday 13th of May. There'll be a link below on this video, and maybe something above for you to follow and sign up for that. Okay, take care. Bye for now.